Imagine saving your entire life for what you expect to be a comfortable retirement, but then realizing to your horror that you're going to run out of money. How can we reduce the chance of that happening? In this video, I'll show you some exciting new research which provides a fascinating global perspective on how to invest to maximize your safe withdrawal rate in retirement beyond the 4% rule. What is a safe withdrawal rate? The idea here is that you don't want to outlive your money. If you withdraw too much money every year from your savings, then you'll deplete the pot before you die. Now you have to make some assumptions here, and there's something that was created called the safe withdrawal rate. And the way this works is that the first year of retirement, you withdraw some percentage of your savings. Let's say it's 4%. And then every year after that, you increase the withdrawal amount according to the rate of inflation. So if inflation's 5%, you increase your withdrawal amount relative to last year by 5%. And that way your withdrawals keep up with the cost of living. And that's critically important if you have a long retirement. Then every year after you've made your cash withdrawal, you rebalance your portfolio. You buy the things which have gone down and you sell the things which have gone up. And that way you also get some additional return from that rebalancing. You're buying low and selling high. And then to work out the safe withdrawal rate, for every 30-year period, you work out how much money you can withdraw initially such that the money just lasts more than 30 years. And then the safe withdrawal rate is the highest initial withdrawal rate which never ran out of money in any 30-year period historically. So let's make that a bit more concrete with an example. And this is a 30-year period from 1970 to 2000. And we've invested 100% in global stocks here, and this is assuming UK inflation. So notice how initially we start off with £100,000 and we withdraw 4.8%. Now I've chosen that number because it made the money just run out the year after the 30 years had ended. If I'd have chosen 4.9%, the money would have run out before the 30 years was up. So in the top panel, you can see the size of our savings over time, gradually dwindling down almost to zero, but not quite to zero. And in the bottom panel, you can see our inflation adjusted withdrawals. Those start out at 4.8% and they gradually increase over time to match inflation. But notice how cumulative inflation over this period increased the withdrawals tenfold, such that in 2000, we were withdrawing more than 40,000 a year. So this was just one 30-year period. We'd repeat this exercise for every 30-year period, 1971 to 2001, 1972 to 2002, and so on. And we'd choose the highest withdrawal rate, which wouldn't have exhausted the pot in any of those examples. Now, the guy who came up with all of this stuff in the first place is William Bengen, and you can see a picture of him here, and also a copy of the paper where he first published the idea of this 4% withdrawal rule. Now, this was a fairly limited study. He only looked at US assets, he looked at stocks and bonds, he didn't have any other asset types. And if I read from the conclusion of his paper, he said, determine the highest withdrawal rate that satisfies the desired minimum portfolio life, 30 years in our case. For a client of age 60 to 65, this will usually be about 4%. So there it is, the 4% rule, which everybody makes fun of, but which actually is a pretty good estimate. So Bengen's study was US specific and it wouldn't necessarily generalize to other countries. The evidence I'm presenting now is from the new exciting paper from Tyler. He's the creator of the Portfolio Charts website. And I was really excited, as was my podcast co-host Michael Pugh, who you can see beside me in this tweet, when he agreed to give us an interview. And if you want to listen to that, just go to our podcast, Many Happy Returns. Now, somebody replied to that tweet saying, oh, it's so nice to hear Tyler's voice. I've never actually heard it before. I was lucky enough to actually see Tyler, and what's really surprising is he's the spitting image of Billy Bob Thornton, even down to the southern accent. So you could say that Tyler is the bad boy of safe withdrawal rates. Now, what Tyler tried to do is to work out which portfolio would give you the best withdrawal rates. So how does your portfolio affect those rates? So let's start off with a really simple portfolio, which is 100% stocks, therefore very crashy, quite risky. And this is 100% developed ex-US stocks. So only developed markets, but excluding the US. Now what this graph shows you, all of these lines that you can see are 30-year periods. So starting in 1970, 1971 and so on. And notice how the graph focuses in on the worst 30-year period, and that's the safe withdrawal rate. In this case, that's 3.6%. How about if we switch to something like gold, which is supposedly a safe asset? Well, in that case, the safe withdrawal rate is much worse. It's only 1.5%. So single assets are problematic, particularly if, like gold, they don't tend to have good long-term returns. The surprising one, in my opinion, was money market funds or bills. There the safe withdrawal rate was 2.9%, which isn't too bad considering their awful long-term returns. I suppose the fact that they have a very low crashiness certainly helps there. Now Tyler compares single asset types like stocks, bonds, bills as being like ingredients in a cake. Each of them on their own is insipid. We wouldn't eat salt on its own, we wouldn't eat flour on its own, but when you combine them, you create something delicious. And that's because they tend to complement one another's behaviour. They don't all crash together, they do diversify, and when one is doing badly, there's always something which is doing well. Or at least that's true if you do diversify. So with that in mind, now let's turn to the best global safe withdrawal rate. Now Tyler's a big fan of work by Bengen, Fau and other people, but what the limitation of those approaches has been was that they were very US centric. But what if you don't live in the US? Or what if the US's returns will revert to what you'd expect in other developed markets in future? That's not an unreasonable assumption. So what Tyler did was to take 10 developed markets, those are the checkboxes you can see beside me here, and he looked at 7 different asset types. So it was domestic bonds, foreign bonds, domestic stocks and foreign stocks. The bills he looked at were always domestic, and then finally commodities and gold. Those are real assets. So how can you combine those to create a global withdrawal rate, which isn't country specific? Well, it involves a lot of number crunching and a lot of scenarios. So what he did was to look at every single possible portfolio combination in steps of 10%. And with 7 assets, if they add up to 100%, that creates 8,008 potential portfolios. He also looked at those 10 different countries and 40 different 30-year time periods. And that created 400 retirement scenarios, 40 times 10. So what we're doing now is instead of looking at the safe withdrawal rate over every 30-year period for one country, we're doing it for every country in that list. And if you're wondering which portfolio came out on top, here it is. Here's the big reveal. Now here it's plotted on a graph of risk on the x-axis, that's the Ulcer Index. That's a measure of how deep crashes are for a particular portfolio, but also how long they are and how frequent they are. So crashy portfolios have a high Ulcer Index. And in this case, the portfolio has a low Ulcer Index. It's only about 9%. The safe withdrawal rate of this portfolio is 4.4%. And the asset allocation is really interesting. It's 10% stocks, those are domestic stocks, 30% foreign stocks. So there is a domestic bias here, unless you're in the US, of course. And then we have 20% bonds, 10% commodities, and a huge 30% allocation to gold. Now, I'm not a huge fan of gold myself, but on some platforms you can't even buy it, like my Vanguard UK platform, for example. So I think one interesting thing to look at is to see what happens if you exclude gold from the possibilities. So that's what we can see here. Notice that the cloud of portfolios now has a lower safe withdrawal rate than it did when we included gold. Also that the Ulcer Index is now a little bit higher. It's shifted to the right-hand side of this graph. But notice also that the allocations here have changed. Of course, we have no gold in this portfolio. We still have 10% commodities, but foreign stocks have gone up by 10%. Bills have now entered the portfolio, so a money market fund has probably taken some of the safety play that gold represented. And also domestic bonds have been swept out altogether and they've been replaced by foreign bonds. So the papers we're talking about today are about which portfolio has the highest safe withdrawal rate. But what if you want to use a slightly more elaborate set of rules to determine how much you withdraw each year? If you're a member of our premium website membership, then you get access to a suite of these trackers. So for example, if you want to try one of our drawdown calculators, we have 3 that you can choose from. One of them is the Vanguard Dynamic Withdrawal Strategy, another one's called Guyton Klinger, and the third one is the Boglehead's Variable Percentage Withdrawal Strategy. Now we have an explainer video that shows how to use these tools, and of course you can discuss it with other members as part of our chat application. So if you are interested in our membership and you want to learn more about it, just go to our website pensioncraft.com/membership, and you'll also find a link to that in the description below. But what if you're not completely focused on safe withdrawal rates? What if you're really terrified of loss? In that case, you'd be focused on the ULSA index, sleeping well at night. And that means we'd be looking for the least crashy portfolio. Now on our ULSA index versus safe withdrawal rate plot, that's actually the portfolio which is to the far left, and it's highlighted on this graph. And it has very safe investment, and it's also a very simple portfolio. I love this one. The foreign stocks make up 20% of the portfolio, so there is a little bit of risk in the mix. But bills, money market funds, make up 50% of this portfolio, and gold a huge 30%. But for such a safe portfolio, this has a surprisingly high safe withdrawal rate of 3.8%. Of course, the ULSA index is super low, it's only 5%. Now that's just one study. What if we were to compare it to others? Now there was a paper that came out in 2023 which caused a stir because of its conclusion, which we'll come to in a minute, but it was called Beyond the Status Quo, a critical assessment of life cycle investment advice. And I made a video about this called Has Vanguard Got It Wrong? Now this paper approached the problem in a slightly different way to Tyler. This was using a method called simulation. So instead of looking at historical returns and finding the worst possible 30-year period, this took returns from the past and played them again as if they replayed into the future. It also studied a US couple, so it was still US centric in that sense, although it did use equity returns from many markets across the world. It also simulated how long people live. Not everybody's going to live into retirement, so it didn't assume a 30-year retirement period, so it was more realistic in that sense. And it also simulated things like losing a job and not being able to save, using actuarial data from the United States. And it took into account the US Social Security system. One way in which it was more limited than Tyler's approach was the choice of portfolios. They only looked at 7 different portfolios, which come in 3 groups. The first group are safe harbor portfolios. These are kind of safe things, but not super safe. For example, like target retirement funds in the UK. In the US, they're called target date funds. In these portfolios, you start off with lots of equity and then gradually dial down the equity as you get older. Or maybe a 60-40 portfolio, 60% domestic stocks, 40% domestic bonds. Another variation was to take the stock allocation and split it into 50% domestic, 50% foreign, and then keep the 40% domestic bond allocation. Another approach is to dial down the equity, like a target retirement fund, using the rule of 120 minus your age. So if you're 20, you'd be 100% in stocks. If you're 80, you'd only be 40% in stocks. And again, that came with either just US domestic stocks or a split of domestic and international. Then we've got a super safe portfolio. This is just T-bills or money market funds. And then finally 2 equity strategies. This was 100% domestic stocks, or 50% domestic, 50% international. Remember that one. And here's the shocking part, which is if you look at the wealth at retirement over all these simulations, and here focus on the 50th percentile, that's the typical case, the portfolio that came out on top was just stocks, 100% stocks, no bonds at all, no bills. That's the stocks/I portfolio that you can see at the bottom. So that was the portfolio in which it was 50% US stocks, 50% non-US. And that portfolio just kept on coming on top, no matter what statistic you look at. So it topped wealth at retirement, it topped wealth at death. So this is the amount of money which you'd leave to your beneficiaries. That was also highest for that portfolio. And then even more surprising, because stocks are, as we know, crashy, the ruin probability, which is the probability of running out of money before you die, that was lowest for that portfolio. And this was because of the very high return you get with stocks. So the ruin probability for that 50-50 US, non-US portfolio was only 8%, 8.2. Only the 60-40 portfolio was comparable. The ruin probability there was 10.9%. Now that flies in the face of everything that you're taught as you're learning about asset allocation. Diversification across different assets is supposed to improve your outcome. But what this showed was that 100% equity was actually a pretty good strategy. And then finally, a paper by Withdrawal, who's another bigwig in the world of safe withdrawal rates, did a similar international comparison as Tyler. He did this in 2010 in a paper called An International Perspective on Safe Withdrawal Rates from Retirement Savings, the demise of the 4% rule. And what was interesting about this paper was that it had data going all the way back to the early 1900s. And that means that it spanned the 2 world wars. And if we look at the best safe withdrawal rate by country, notice at the bottom of this table, we have countries which were either invaded by Germany or Germany itself, which of course lost both wars. Now this is one of my criticisms of safe withdrawal rate, which is that it always focuses on the worst case by definition. So if you do include these war scenarios, then you always end up with an approach which is too conservative. Perhaps war will happen again in future, perhaps your country will be invaded and you should have been more cautious, but I think that's unlikely. And I think most people wouldn't want to condition their withdrawal rate and their income in retirement on these awful scenarios. Now, one thing that's very cool which Withdrawal did was to vary the amount of equity for every country and see how that affected the safe withdrawal rate. Notice those war-torn countries at the bottom of the graph. The safe withdrawal rates really didn't save the day here. Whatever the equity allocation, you'd have had a low safe withdrawal rate. But notice for the countries at the top, the safe withdrawal rate varies a lot according to the equity allocation. And it also varies between country. So that's why I think Tyler's approach is an interesting one, because it looks at the safe withdrawal rate across all of these countries, or at least across the large developed ones. It doesn't include the war-torn periods, it only starts in 1970, but I think it comes up with some really interesting portfolios. In conclusion then, the learning that I take from all of these papers is that asset allocation is really important. How much do you put in the domestic stock market, in the foreign stock market? All of that critically affects how much you can withdraw in retirement. And what this research allows you to do is to work out a reasonable allocation. Now, you could argue about whether all equity is sufficiently diversified or whether you also have to include things like gold, but what's clear is that diversification helps. Even in that 100% equity case, you could see that having 50% US, 50% non-US perform better than US alone. So whether it's diversification across region or across asset type, usually it's going to help you in retirement. And then finally, domicile matters. And this is why things like gold seem to help. It's a non-country specific investment. If there's a crisis, gold usually provides some kind of support, no matter which country you live in. But what was also surprising was how good cash is. Despite the fact that cash has a very low long-term return, it actually helps maintain a safe withdrawal rate in retirement, as we could see from that minimum ULSA index portfolio. So remember, if you do want to play around with those different withdrawal rules, then you have access to that as part of our website as a premium website member. And you can learn more about that by going to pensioncraft.com/membership, and there'll be a link in the description. And as always, thank you for listening.